Okay, so we're going to continue on with allocating income. We're just going to add a little extra layer of difficulty to it, I guess. So far, we have had situations where they had a salary allowance, interest on their capital, and their remaining income was split equally. So that was pretty easy. So what do we do if it's not divided equally? Well, we have to figure that out, because usually it's going to be given to us on a ratio, like 2:1. It's 2 to 1. So I said on here, you will see some problems that express the division of partnership net income or remaining net income in a manner other than equally. So how do you figure out who gets what? So here's an example of what to do. Maybe the verbiage in the problem says any remaining net income is divided to partner A and B 2 to 1. That's how that reads. Well, that means partner A gets 2 parts, partner B gets 1 part. So if you add partner A's 2 parts to partner B's 1 part, that gives you a total of 3. Okay, so you're using 3 as the total. So partner A gets 2/3, partner B gets 1/3. Does that make sense? And that could be the same if it's like 3 to 2. Your total's 5, so it's 3/5, 2/5. Okay, that makes sense? Sure. Okay, we're going to work something like that. So, all right, notice that this says which problem it's like in your homework. We've got Steve Prince and Chelsea Bernard that formed a partnership. And here is how they are dividing their income. Annual salary allowance to Prince, $39,000. They're not saying anything about Bernard, so apparently Bernard's salary is non-existent. So we'll just assume no salary for Bernard. Dang it. Okay. If I don't mention it, then there's nothing there. Don't worry. They don't both always have to have a salary. In this case, only one of them is getting that salary allowance. Then each partner will get 9% interest calculated on their beginning capital balance for their interest allowance. And down here, they tell you what their capital balances are. 40 for Prince, 170 for Bernard. All right, the net income for the year is $250. So we're trying to figure out how much net income for each partner. How much are we going to show is distributed to each partner's capital account? Okay, so we'll start with salary. So Prince has got 39. And notice that it says annual. So we don't have to multiply anything there. They're giving us the full year amount, not a monthly amount that we have to multiply. All right, Bernard has nothing for salary. So we'll just add that across. That one's easy. Okay, so 9% interest on each partner's capital balance. So Prince, how much is Prince going to get?
3,600.
Yep. So you'll take $40,000 times 9%. 3,600. Yes. So that's Prince's interest allowance. So 3,600 will go here. Now what about for Bernard?
15,300.
15,300. And you'll do it the same way, 170,000 times 9%. Okay, remember, your interest is calculated. Be sure when you do take a test, read the information. Interest on the capital balance. It's not interest on the salary amount. That's a common mistake. Interest on capital. So you're not going to take that salary amount and multiply it by the interest rate. It's the capital. Think about the capital as their investment. It's like you putting money into a bank account, a savings account. It's your investment in the bank, and they're going to pay you interest on it. They wouldn't necessarily pay you interest on how much money you make at your job. You know what I'm saying? It just doesn't make sense. Okay, so we're going to total these up so that we can figure out what remaining income is. So we've got 15.3 for Bernard, and we've got 42.6 for Prince, right? So what's the total of these two?
1890.
18.9 here. And then what's my total of
57.
57.9? All right. So to figure out what my remaining income is, I'm going to drop my net income here because I want to figure out what do I need to add to 57.9 to get 250. So 250,000 minus 57.9.
192.1.
192.1. That's my remaining income. One last kind of, I want you to see it, but it was kind of out of whack. So we're going to put 192.1 here. Now, how does the problem tell us to divide any remaining net income?
3 to 1.
3 to 1. So how much does Prince get?
3/4.
Okay. And how much does Bernard get?
1/4.
1/4. And if you want to put that in percentages, that's probably easier. It's up to you. But let me tell you something about dividing it out. Hey, in your calculator, when you're working through this, 192.1 divided by 4 times 3. Don't hit the equals in between because if your calculator's rounded, you'll miss some of the decimal pieces. It may make it a little bit off with your Cengage answer. You could be $1 off and not realize what's going on. And it's rounding. So don't hit equals in between. Just say divided by 4 times 3. Just keep the equation going. You know what I'm saying? You know what I'm saying? You'll ever see the numbers. No, I haven't seen that maybe no. I wouldn't. It might be funny to you. I'm not sure. It's my time, but every time I say, you know what I'm saying, it reminds me of that baby. I don't have things like that that you think about. All my movies are old. All right, so if I'm gonna divide it out 3/4 and 1/4, how much is Prince gonna get of net income? 192.1 times 3/4.
144 is 0.75.
Okay. How much for Bernard?
48.25.
Check your math going across. I'm gonna tell you, I did one earlier. It was the next one. I was trying to figure out, when you're working your way down this way and you're trying to figure out remaining income, if you've done something wrong, you may not pick it up going down. But once you've allocated it and you check your math across, they may not add up the same. And that's how I caught my error. So make sure you always add across and down when you're done. Well, and on every line, really. Okay, so how much net income is Prince allocated? What's my total? Just add it down.
186.75.
And then add it across and make sure that they work. Okay, you remember like when we were first talking about this, I said, somebody may have a higher salary allowance than another partner because maybe they spend more time or they've got some kind of special skill or something like that. And that maybe another partner puts more money in than the others. Well, this is a case like that. If you were looking at this, some things you might be able to assume. Prince is going to be putting more time into the business because Prince got a salary and Bernard did not. But if you look at their capital balances, Bernard's is higher. So maybe Prince said, okay, I'll work there, I'll put the time in, and Bernard's putting the funds in. So when you allocate using the salary allowance and the interest allowance, it makes it more fair. Y'all see that? Okay, feel good? Yeah. Okay. Okay, so you've got Prince and Bernard 3-to-1. So that means Prince gets 3 parts, Bernard gets 1 part. So if you add up Prince and Bernard's parts, what do you get?
Yeah, well, no, I'm not talking about that.
Oh, I'm sorry.
How we got the 144,000.
You're gonna take this and you're gonna use these percentages we came up with, or those fractions.
So we use the 192.1.
You're gonna take the 192.1 and multiply it by that fraction you came up with up here. Yeah, so for Prince it's 3/4, Bernard it's 1/4. So your total should come out to be the 192.1. Make sense? Okay. Y'all do this next one and see if it's clicking with you. You work this one.
For like journal entries say when we're recording the salary allowance,
Mhm.
it's considered a credit, right?
Mhm.
Or does it only like does it go in the credit category or in the debit category?
The salary allowance, it didn't go anywhere. What goes in, like when you're making your closing entry, is what you come up with on the bottom. So what you're trying to determine is, okay, when I'm closing the books and I'm trying to figure out which partner is getting how much capital, that's what you're figuring out. They're not technically getting a salary or interest, but what you're figuring out here at the bottom is, okay, when I make my closing entry, I'm gonna credit Prince's capital for 186,675, and I'm gonna credit Bernard's capital 63,325. Does that make sense? Does that answer your question?
No, because I was asking about like so if we're doing like one of our sheets where we do like the balance sheet and the and the journal, like those entries.
None of this goes in an entry. This is simply a calculation that you're doing to figure out when you make your closing entry, how much each partner gets. This is not stuff we're gonna make entries for.
Oh.
They're not actually getting a salary, they're not actually getting interest. We're just using this as a method to figure out how much are we gonna put in each partner's capital account when we close the closing entry. So none of this will be journalized.
Okay, that makes
This is just an allocation calculation, just a calculation, not journal entries. The only part that we'll do journal entries for is this piece down here, and it'll be the bottom part of our closing entry, our first one. Okay? Did I answer?
yes,
Okay.
that makes sense.
Anybody else have that question? Like, how are we gonna do this as a journal entry? This is not a journal entry. This is just a calculation. I'm glad you asked that, though, because I mean, sometimes I don't anticipate what questions y'all are gonna have, so. Now be sure you ask me if you have a question. see things happen. Garrett spilled water all over his pants, and he didn't think that was a good idea to come to class. Don't blame him. I spilled a chocolate protein shake all over myself last week. Shirt, pants, coat, in the car. And I didn't even really spill it. I just kind of, glass kind of slipped and it kind of jumped out. Things happen. Yeah, but if you're a habitual offender, don't get suspicious after a while. So, all right, y'all make sure you notice on here, this is monthly, not annually. So you need to make sure you're watching that when you do a problem. It's a monthly salary. We're looking for annual on the allocation. So you'll have to multiply by 12. Did y'all catch that? So come up with that? Nope. Where'd you mess up? Everywhere? You understand why? Yeah. What about it? Well, and see, I did something crazy when I was doing mine. I didn't add it up right or something across. So I came out with the wrong remaining net income. So that's why I'm telling you to check your math both directions to make sure that it, I mean, that doesn't necessarily mean you'll catch a mistake, but I caught mine. Questions? Yes?
Where did you get negative from?
Where did I get the negative from? Okay, so remember that we always want this number here to be net income. Okay, so when I did my allocation, and the allocation is going to be the same It's set up in the partnership agreement. So you got your salary, you got your interest amount. So, I mean, they set it up based on what they thought they'd have in net income. Well, maybe their year was lower. So their allocation came out higher than their net income. So we've got to reduce it so that it will be the amount of net income.
Okay.
Because think about it, when what we're doing here is trying to calculate how much is going to be credited to each partner's capital account when we do the closing entry. So if we got 140 in net income, you know, first semester that all went to the capital account for the owner, right? So we're trying to figure out how to allocate this 140 to each partner. So we'll debit revenues, credit expenses, and we'll credit Marshall by this much, Sharp by this much. If we used something different, we're going to be out of balance. Our entry won't work. That makes sense? So this itself is not an entry. We're trying to determine, what these two numbers are here. Dang it. Here, so that we can apply that when we do our closing entry. Does that make sense? Y'all, if y'all messed up something, do you know why or where it is, or do you need me to go over something, or going? Y'all good? Yes.
Okay, so I know I mixed up like at the very,
At the very beginning?
well, I got the 75, 63, 138 time. And I guess I multiplied, I added my 12%, right?
Okay, so what did you get?
Right. But for my entries on capital balance, I think I got 9,000.
Well, then probably what you did was multiply by the salary amount, not the 9,000. It's 9%.
Yes, we did. I did that at first too.
Yeah, see, and that's a common mistake. Y'all be careful with that because you're supposed to. Okay, that's 6750 if you do that. So that's not the same. Your interest, you're going to calculate on these numbers, not your salary. So just make sure that's what you're using. And it may just be you keyed it in wrong. I mean, there's no telling. 12%. Okay, so let's see. Yeah, that's exactly what you did. You took 12% of the salary amount. That's not right. Take 12% of the capital, not the salary. They're not allowing them interest based on how much they're paying them in salary. They're allowing them interest based on how much money have they put into the business. What is their investment? Logically, just think about that. Would they pay them interest on their salary or their investment, or allow them salary or interest allowance? Sorry. Allowing them interest on their salary doesn't quite make sense. And just make sure you're reading the directions, because it tells you, you know, the interest allowance is calculated at 12% of each partner's capital balance. So just make sure you're, well, capital accounts. Okay, so capital accounts, each partner's balance. So it's talking about their capital balance, not their salary.
Okay.
That's a common mistake. And the thing is, you'll get the first line right and you'll miss the whole rest of the problem. So just make sure it's probably a good thing you did do that, because maybe you won't do it on the test. Happens a lot. Okay, so is that everybody's questions? Y'all good? Moving on to part 3. So I know that's like something you're supposed to read for homework, but we'll go ahead and knock out some of these blanks, maybe make your quiz easier. All right, so a company can amend their existing partnership agreement to allow for a new partner to come in, or maybe a partner to leave. So by doing that, by amending the partnership agreement to allow for that, the business can keep operating without having to start with a new partnership agreement and a new partnership entity. So it allows them to keep going. It's not an interruption to business because they've got somebody coming in or going out. All right, so there's 2 different ways that a partner can be admitted. They can either, and this is a new partner, they can either purchase the interest of one of the partners that's already there, or even a partial interest, or they can contribute some assets to the partnership. They can buy in. So if they purchase an interest from one or even more of the existing partners, that transaction is taking place between two individuals outside the partnership. So that money exchange or whatever's going on outside. So what happens on the books is that the partner that is selling, their capital account will be debited and the new partner will have a credit to their new capital account. But it's based on what percentage of the existing partner's capital they're buying. So if they're not buying all of it, it would be whatever's in their capital account times what they're buying. If they're buying all of it, then all of it would move. It's essentially renaming it, but we're renaming it by taking it out of the old partner's capital and creating a new partner capital account for the new one coming in. So essentially all you're doing, I mean, if we didn't have to make an entry, we could just, you know, scratch out their name, but to make it legit. Okay, so any gain or loss on the sale of the partnership interest, doing it this way, it doesn't affect the partnership. So let's say, you know, this partner's gonna sell his partnership interest for 50 grand. Well, maybe his equity account or his capital account only has 40 in it. So he's got 40,000 in the business and he's gonna sell it to this new partner for 50. Well, he's gonna make $10,000 on that transaction, but that's on his own books or tax return. The partnership is only gonna see a shift from this person to that person when a person is buying another partner's equity. Now, if a new partner gets in by contributing assets to the partnership, and typically you're gonna see them putting cash in. I'm gonna put this much cash in, I'm gonna get this much equity, now I'm a partner. That's what contributing assets is. So when that happens, you're obviously increasing total assets because you're adding cash. And the other side of that entry would have to be equity because they're buying in, they're getting an investment. And accounting one, when an owner put money into the business, it was an increase to cash and an increase to capital. It's the same concept. So your total assets and your total equity will be increased. When they're buying an interest from somebody, there's no effect on those totals. The totals don't change. We're just shifting the capital from one partner to another. We're renaming it essentially. Okay, so when a new person coming in is actually contributing assets to the partnership, they'll write a check, you know, to the partnership account, bank account. It'll go into the partnership and they'll get equity as a result. So this transaction is between the partner and the partnership. So it will be recorded and you will see total assets and total equity go up. Does that make sense? Okay. So something that has to be done before a new partner is admitted. Now, in this case, we're looking at a partnership that's already been in existence and someone from the outside is coming in, or maybe a partner's getting out. But this partnership has already been in existence. This is not like at the beginning of the chapter when we have a couple of folks coming together and forming a brand new partnership. This one is an existing partnership, so it's different. However, remember when we were making the entries to record partner A's contribution to this new partnership, we did everything at current value, right? So that they would get, you know, enough equity to reflect the worth of what they're putting in, right? Yes, no, maybe? When you show a new partnership being formed and you've got partner A over here putting in cash, receivables, land, blah, 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 everything's going to be put in at current value. So when you have a new partner coming in, before that new partner is booked, it's put on the books, the assets are going to be adjusted to current values. Just like everything, any new partner coming in, the value's got to be at current, okay? So if there's an adjustment needed, like maybe your land has appreciated in value, so you have to increase your land. Well, you're going to split that adjustment between the partners, just like you did the net income. If you have fixed assets on the books. And they tell you, well, you've got, you know, your building is 500 and your accumulated depreciation is 50 and so on. Take the accumulated depreciation off and make your building account equal to whatever current value is. I'll show you in a minute, it'll make more sense. All right, so the reason we do this is that if it's not done, then the new partner may end up sharing in gains or losses that don't really belong to them, you know? Like, so let's say the original partnership, maybe they bought a building for $500,000. Or let's say land, so we don't have to think about depreciation. Let's say originally. Okay, so now it's worth $650. So what does that tell you about if they were to sell it today at $650, what would they have?
150,000.
Gain, right? They've made $150 on it, right? Well, if they don't adjust this before the new partner comes in, that new partner shares in that $150,000 gain. And that's not really fair because that new partner wasn't here during all this time, right? So that's why you adjust to current values. And one of the things I first thought of was like, well, how does that work when, you know, they eventually, maybe they do sell it? Well, you have to keep up with all this stuff on the side for tax purposes. But for the books, we're going to adjust everything to current values. Any kind of gain that was there before it was adjusted, the old partners have to, that's their problem. We're going to adjust everything to current values to make it true up everything, get everything on an even playing field before this new partner comes in. All right, so that's just a little side note that kind of summarizes what we just talked about amending the partnership agreement. Forgot to erase. All right, so this is just a recap of what I had already told you. That purchasing an interest, this is just a recap summary and tell you just the summary of it. All right, so let's look at this particular problem where Tim Morton sells, forgot to erase. It will. Okay, in this situation, we've got Tim Morton. He's the existing partner, and he's selling a fourth of his interest. He's not selling the whole thing, he's just selling a piece of it. The business is called Event Planning and Consulting. And Avery Castle is gonna pay 20 grand to Tim for a piece of his ownership. So he's paying 20,000, he's getting 25% essentially. All right, so this information here is just kind of thrown in here to throw you off because you're not really using that. This is useful because we need to make a journal entry. Okay, so Morton's capital balance on the transaction date is $60,000. So what would be 25% of that equity, or a quarter?
15,000.
15,000. So you can look at it and tell, well, he's paying 20 grand, but he's only getting 15 in equity. Okay, well, that's between him and Morton. All we got to record on the books is that we're shifting this equity. So we will debit Morton's capital and we'll credit Castle capital for $15,000 because he's buying a quarter of it. What he pays is, you know, outside the books. We're just shifting it. Does that make sense? He's purchasing an interest, so this is how it works. He's moving it. Make sure when you're reading problems that you're looking at what's happening, what's going on. So you've got one partner selling his interest. So in that case, total assets aren't going to increase. Total equity is not going to increase. We're just moving it to the new partner. Okay? Okay. So let's see. On the next one, oh, wait a minute, this is just a note. When an individual coming into a partnership is buying the interest of an existing partner, the exchange of money takes place outside the partnership's books. So essentially, that Castle guy, he wrote Morton a check, 20 grand. It's going straight to Morton's checking account. It's not going in the business. So he's giving him 20 grand and he's going to sign over 25% of his equity. But we're only going to move 25% of the equity. We're not going to show 20 because then that'd be more, right? Does that make sense? Okay. Just make sure that you understand assets aren't changing. Equity, total equity is not changing. We're just renaming it essentially. Okay, so on this next one, oops, we've got a partner getting in to an existing partnership. All right, so you've got Harold Banner investing 25 grand in this printing partnership. So he's getting in. The partnership's already there. It's already in business. So he's putting in 25 and they're allowing him equity of 25. It's important that when you're reading these problems, not so much right this minute, but as we move forward, that you compare those. He's putting in 25, he's getting 25. Because when we get on into the chapter, you'll have situations like, I explained it in the first class, so everybody pretty much knows Mississippi sports medicine, right? Y'all have heard of it. When they first, I don't know when they first started, but I remember like back when we were in high school, because my brother had to have knee surgery, I think there was like a handful of doctors there. I mean, now I don't know how many they got, 30, 40, 50. It's grown. So think about this. You've got this big medical practice, big orthopedic medical practice, and you're a new doctor coming out of school. And they offer you, let's say, $500,000 in equity for $600,000 in cash. So you're having to pay more than you're getting, which seems like a ripoff. However, you are getting into a very successful, established practice that will set you up and is putting you in a position to do well and to develop your patient base and succeed, right? So you're willing to pay a premium to get into this partnership because it's a really good partnership or a really good practice to get into. They're already established. They already have everything there. You're just kind of stepping in and it's reputable. Everybody knows who they are. So it's worth it to you to pay a premium to get in, which I wouldn't doubt if that's the case. For real, I don't know. But let's say on the flip side, maybe you are a new orthopedic doctor, surgeon, and you have just gotten out of school. You finished your, residency, your orthopedic fellowship or whatever it is they have to do. I don't know. So in the process of all that, you've learned some kind of really new procedure that is on the cutting edge. And so you've got skills that are worth something. So maybe they'll pay you $600, or they'll let you pay $500 for $600,000 in equity. So the reverse, you're only paying $500, but you're getting more in equity because they want you really bad. So you're getting a discount. You're getting the benefit of the transaction this time. So does that make sense? And that's kind of how it works. But right now, we're starting at the beginning. He's paying 25. He's getting 25. Okay, so I just want you to be in the habit of looking at that. He's putting in 25 in cash, and in exchange, he's getting 25,000 in equity, so it's even. All right, so in this case, it says, assume that the partnership's assets are reflected at current value already. We don't have to adjust anything in this particular problem. It's already been done, so we're just gonna journalize the entry to record his contribution. So we will debit cash. He's putting money in, $25,000. And we'll credit Banner Capital, $25,000. So again, compare the investment to the equity. Try not to overcomplicate it. the more we add information, I know it starts to get kind of tricky. But, that's a simple one. He's putting in 25, he's getting 25, so nothing extra there. All right, so the next one. There's another note about how that transaction we just did, that took place inside the partnership. He's writing the partnership a check and so on. So examples 1 and 2 that we just did, they're based on the assumption that the assets are already adjusted to show current value. Because we left that step out to make it easier. Now we're going to look at examples where the assets do have to have the value adjusted. So see what that looks like. So before a new partner is admitted, partnership assets must reflect current values. Current and market are the same thing. It's what you could sell something for. What's it worth? What would somebody pay you for it? So if there are any adjustments you have to make to an asset, you're going to split it amongst the partners based on their income allocation ratio, which would be that like remaining net income kind of thing. It's either equal or it's got some kind of ratio. All right, so in this next one, we've got Ken Jackson investing in this partnership, Blake and Sutherland, and he's putting in 60 grand and he's getting 60 grand of equity. So prior to the investment, the land was determined to have a market value of 300, but it was booked at 250. They bought it at 250. When they bought it, it was 250. Over time, it's increased in value. Now it's worth 300. So we've got to make the land on the books be 300. Now, Amy and Jerry, Amy Lake, Jerry Sutherland, their net income sharing ratio is 2 to 1. So let's break that down real quick. Amy Lake gets 2 parts of the net income to Jerry Sutherland's 1 part. If Amy gets 2 and Jerry gets 1, the total is
3.
I don't mean to like kindergarten y'all to death, but it just, sometimes I gotta have it broken down on. All right, so how much would Amy get out of that 3?
2/3.
She gets 2/3 and Jerry gets
1/3.
1/3. And if you add them together, that's 3/3 and that's the same as 1. So that's the whole. All right, so the first entry we're gonna record is the revaluation of the land. So what we do is we're gonna debit land for $50,000. That's the adjustment amount. Because it increased. Don't record land at 300,000. You've already got 250 on the books. If you record 300,000, now your land is showing as 550. So think about what's happening. What is it you need to do? What do you need to record to get that amount that's already at 250 to 300? You just got to add 50. Add the appreciated amount. Add the extra, the difference. And then that 50 grand that you're having to increase land by, you're going to give it to the existing partners in their capital accounts based on their ratios that we just came up with. They told us 2 to 1. So we figured that's 2/3, 1/3. And that's how it works out. All right. Does that make sense? Yep. Can you see? That better? So the second entry is to record Jackson's entry into the partnership. Well, he's putting in 60 in cash and he's getting 60 in equity, so that's pretty easy. What's wrong? 16,667, 33,333. Just round it. It's a funky number. You can tell when I make them up. Sometimes the book does numbers like that too. I try not to make them weird like that, but it's just, it happens. All right, so another note for you. We have to do this asset revaluation right before the new partner is admitted. So the new partner won't be included in this revaluation thing, just the old ones, okay? All right. Y'all do this one. Work on this next one, example 4, and see how you do. gotta make sure you understand it before you're on your own. Bless you. Bless you's not the right thing. Bless it. Are you sleepy? Oh, no, I know the feeling. It's warm in here town. Still working on it? You finished? Finished? All right, y'all check your answers. See how you did. I don't want to do that. Use my RAM. Have you already read part 3, or was that read your quiz, or was that 2 that you did? And you did homework
For one.
for 1. Y'all kind of ahead. So I'll probably move your I'll probably go ahead and move that part 3 up. I'll give you a little extra, but you don't have to read since we kind of went over it. You just have to take a quiz. So you get 3 chances and it'll reinforce your knowledge. And give you a good quiz today. So probably, since you don't have to read, get a reading quiz. Oh no, I'll think about it. I don't want to give you another reading and a reading quiz. Okay, I'm done with y'all. We're at the same spot that the other class was at, so we can stop for the day.